2024 in the fourth quarter, we kind of went out with a whimper. I know we talk about and have talked about small caps a lot on this podcast and our monthly podcasts as well, going back for however long. Uh, November 2024 was a really good month for small caps. Small caps ended up that month up over 11%, and that was mainly attributed to that really big post-selection pop. Unfortunately, we didn't get a continuation of that in December, so we did go out with a whimper there. So what's interesting about this is when we look at November and small caps, November was the 22nd time in history that the Russell 2000 had ended up at least 10% in a month. And when you start the clock on those types of positive months, uh, the Russell 2000 is higher 6 months out, 90% of the time, and up 11% from there on average. So we're really putting history to the test on that. And of course, the market has a tremendous amount to digest right now when it comes to valuations and particularly policy with the incoming administration. And what I think this all really boils down to right now, when you combine all of that, is interest rates. So you can see here on the screen right now, this is a graphic from High Mount Research, which basically shows the 10-year Treasury note and then um, a calculation for basically trend. And what's notable here is the 10-year peaked just shy of 5% back in October of 2023. And that's when we really started to see stocks kick back into gear. And you can see this, it's basically at the end of the graphic here. This goes all the way back to 1980, but you can see there that 4.93% on the right side basically shows where the 10-year topped out back in the fourth quarter of 2023. And what we're seeing now, and I think this is why we saw a pretty bad December in stocks in general, and particularly small caps, is we've seen that 10-year Treasury trending higher in terms of yield. So this appears to be where we're back in an environment of elevated stock bond correlations, much like we had in 2022. So it'll be interesting to see what happens with yields from here on out going into 2025. But right now, the trend in yields is higher. And if that continues higher, it's likely going to have implications for the US dollar. And of course, having a strong US dollar has historically been a headwind for stocks. So TBD on that. This is another graphic I've got pulled up here on the screen. I think this is something that's sort of evergreen. So not necessarily looking back at 2024, but I think it's a good graphic to look at as we kick off 2025. This is a graphic from NASDAQ Dorsey Wright, which is one of our preferred data providers. And this just shows the probability of hitting a specific percentage decline in any given calendar year, going back to 1928 and then going back to 1970. So if you look to see what's the percentage probability of hitting a certain percent decline, let's just call out 20% going back to 1970. So there's usually about a 20% probability of having a 20% decline in any given year. So that's just some helpful context as we start off 2025 here. And then I want to close out here kind of what I've looked at in 2024. And then as we sit here starting 2025, I want to look at starting valuations and yields, because this is very important, I think, for expectations going forward for stocks and bonds. So what I've got pulled up here on the screen right now is basically looking at PE ratios in the S&P 500 and subsequent 1-year and 5-year annualized return. So it basically says, hey, if you are at a starting valuation of X, what can you expect from history for returns going forward? And that would be your Y-axis here. So as we ended the fourth quarter, we're sitting at about 21 and a half times forward earnings in the S&P 500. And if you look at forward 1-year returns, it's sort of a crapshoot. Just sitting at this type of evaluation doesn't necessarily mean that you're going to have bad returns going forward. The dispersion of returns going over the next year based off history is a scatter plot. And you can see that by the really low R squared statistic right there. Of course, as you go out further and look at 5 years and 10 years and even further than that, the relationship gets a little stronger. But what I think is really interesting, and I saw a post from Jim Bianco on LinkedIn, he shared a variation of this exact same graphic. And I'm going to be quoting him here because I think this is really helpful and a really good way of looking at these types of charts. He says that valuation isn't a timing tool, but it's an expectation tool. Maybe this year is another good year, but based on history, you should expect the next 5 to 10 years to be a struggle with regard to US equities. So I think that's some helpful context as we sit here early in 2025. And then closing things out, we looked at stocks. Let's take a look at bonds now. This is a variation of the chart we just looked at, but looking at bonds and fixed income. And this just shows that starting yields are typically the best predictor of forward returns in the bond market. And this is what I mean when I talk to clients about locking in yields. If you look here, there's a really strong relationship based off of starting yields and forward returns. And so this is what I mean when I talk to people about, hey, if we lock in yields and we assume no defaults on principal or coupons, you can expect this starting yield to be your actual return going forward. So some good charts from JP Morgan Asset Management and High Mount as we start the year. But that's what I'm really looking at. It's basically interest rates and valuations.